November 2025 was one of those months that just gives you whiplash. It was a serious tug of war between these incredibly powerful, positive stories at the company level and some really messy, fragile forces on the macro scene. It honestly felt like the market couldn't decide if it was sprinting towards a year-end rally or just about to fall off a cliff.
And look, this right here, this is the story that was lurking behind everything else. In the middle of October, the market was pricing in a 97% certainty of a Fed rate cut in December. It was a done deal. But by November 21st, that conviction had absolutely collapsed to just 22%. This dramatic repricing was basically the macro earthquake that sent shockwaves through every single asset class.
So, to really wrap our heads around all this chaos, we're going to break it down into 4 dominant narratives. First, we'll dive into the wild swings in AI. Then, we'll unpack the Fed's data dilemma that caused that rate cut collapse. After that, we'll look at some key geopolitical risks. And finally, we'll get into the clash between historical market trends and modern market structure.
All right, first up, the AI sector. For the better part of a year, AI has been the engine of the entire market, right? But November was the month the market really started to ask, okay, but what's the right price for this engine? The month kicked off with a bang. On November 3rd, Amazon drops this news, a landmark $38 billion partnership with OpenAI. This was seen as definitive proof that the boom in corporate spending on AI wasn't just real, but it was actually accelerating, basically pouring gasoline on an already raging fire.
But almost immediately, a fierce debate just erupted, and it triggered a pretty gnarly mid-month sell-off. In one corner, you had analysts from UBS pointing to all the classic bubble signals. The "this time is different" mentality, soaring retail participation. But in the other corner, Goldman Sachs fired right back, arguing that, hey, this is nothing like the dot-com bubble. Today's AI giants actually have real earnings, and their PE ratios are roughly half of what we saw at the peak back in 2000.
And then, on November 19th, it really looked like we had a clear winner in that debate. NVIDIA, the absolute bellwether for the entire sector, dropped its earnings and delivered this blockbuster quote. They didn't just beat expectations, they guided future revenue way, way higher. It seemed to settle the strong fundamentals argument once and for all.
And it's the sheer scale here that you really have to pay attention to. Buried in their report was this number: $500 billion with a T in confirmed orders for their next-gen platforms. This wasn't just some optimistic forecast, this was a concrete backlog. It was crucial reassurance that the flood of capital into AI was translating into real, long-term customer commitments.
And yet, this happened. In a totally stunning reversal, after initially rallying on the great news, NVIDIA's stock closed down over 3%. This was the whipsaw that defined the entire month. Even a perfect earnings report couldn't erase the deeper market anxiety about valuations and, of course, the broader macro environment. The AI roller coaster took one last dizzying turn.
So that broader macro anxiety, the one that even NVIDIA's report couldn't fix, well, it was rooted in our second theme, the Fed's data dilemma. A prolonged government shutdown had effectively blindfolded the world's most important central bank.
The speed of this collapse was just stunning. We went from near certainty in mid-October to total confusion. The key event, of course, was the 41-day government shutdown. It was just long enough to force the cancellation of the October jobs report, an absolutely critical piece of data for the Fed's big December meeting.
So the crucial concept to understand here is this idea of a data vacuum. Without that fresh employment data, the Fed was being forced to make its most important decision of the year using stale numbers from way back in September. This paralysis fueled a new narrative that the hawkish members of the committee would win out, that they'd choose to hold rates steady rather than risk a cut based on old, outdated information.
And the consequences? They were immediate and they were severe. This uncertainty forced a massive repricing of anything sensitive to interest rates. I'm talking long-duration assets like tech stocks and long-term bonds. It also just unwound a huge number of leveraged trades that were built on that assumption of a December cut, especially in the crypto space, where we saw over $1 billion in positions get liquidated.
Now, while that whole Fed story was dominating the headlines, a series of international events was adding another layer of complexity. These were creating some very distinct pockets of risk and, for some savvy traders, opportunity. So there were 3 key developments to watch. First, a temporary trade truce between the US and China was met with basically a collective shrug. Investors just saw it as a temporary pause, not a real solution.
Second, reports of serious peace talks about Ukraine started to remove that geopolitical risk premium from oil prices. And third, a U.S. indictment against Indian billionaire Gautam Adani sent shockwaves through one of the world's most important emerging markets.
And you can see the direct impact right here. WTI crude fell sharply as that war premium just evaporated. The Indian rupee, it cratered to an all-time low after the Adani news broke. But in a really fascinating twist, major banks like Goldman and HSBC actually upgraded India to overweight. Their argument was that the turmoil was a short-term governance crisis, and it didn't really impact the country's long-term growth story. It was creating a buying opportunity and a clear divergence play away from China. And if you look at this chart from November 7th, this is before the Adani news even fully broke, you can see the market was already showing signs of stress. You can see significant weakness in key sectors like energy and IT. The point is, the governance crisis didn't create the problem, it just massively amplified the pressure that was already building right below the surface.
All right, for our final theme, let's zoom in on a more technical battle that played out at the end of the month. This was a clash between those predictable, historical holiday patterns and the unforgiving reality of today's market structure.
Historically, the data for Thanksgiving week is just screamingly bullish. The full week has delivered positive returns almost 70% of the time, going all the way back to 1950. This strong seasonal tailwind usually gives the bulls a really clear advantage heading into December.
But not this year. That predictable seasonal tailwind ran headfirst into a massive structural wall, the monthly options and futures expiry, which just happened to fall on November 27th.
And this matters a lot for market dynamics. The best way to think about derivatives expiry is like a giant automated rebalancing day for the entire market. It forces huge mechanical trades that have absolutely nothing to do with company fundamentals. These flows can easily triple trading volumes and completely overwhelm those gentle seasonal breezes, turning what should be a calm holiday week into a period of extreme turbulence.
So if we bring it all together, November's story was just one of relentless conflict. We saw incredible strength on the micro level, like that NVIDIA report, constantly fighting against a backdrop of macro-level fragility, which was all being driven by the Fed's uncertainty.
And this leaves us with the crucial question for December and beyond. With the government shutdown over and NVIDIA's earnings seemingly settling the AI debate, was enough uncertainty removed to clear the path for that traditional year-end rally? Or was the profound macro fragility we all witnessed in November just temporarily papered over, waiting for the right moment to reemerge? That's the puzzle the market has to solve next.